Welcome to the Introduction to Transfer Pricing. This is a series of short videos where we're summarizing materials covered in Fundamentals for Transfer Pricing as a refresher or an access to the material about how to begin in transfer pricing. The topic of this video is the economic theory underlying transfer pricing, which is essentially why does the transactional net margin method or the comparable profits method work. In earlier videos, we described what those methods are, how they're applied, but we just want to talk a little bit about the economics that are underlying using those methods. So the economics of pricing and profits. We talked in earlier videos about the determination of price in a competitive marketplace and that it occurs where supply equals demand, where those two curves intersect graphically. That is when the suppliers in the marketplace are willing to supply that quantity at that price, and it's exactly equal to the amount that the consumers or the buyers in that marketplace are interested in purchasing. And we talked about some of the things that might affect supply and demand curve and how the intersection of those two curves will then determine where the prices are going to be in the marketplace. And then we looked at the equilibrium for a small firm. Now, we also talked in a second video about the difference between economic profits and accounting profits. Economic profits, remember, will generally in a competitive environment be zero because an economist considers the opportunity cost as one of the costs that is incurred in making economic decisions. Accounting profits, on the other hand, will not put the opportunity cost onto the profit and loss statement, and therefore, in a competitive situation in which there are zero economic profits, there's still going to be positive accounting profits. And those are important for us because they're essentially going to show us the return for taking a risk, the return for purchasing assets and putting them to work in a business. It may be also a return for marking up above the cost of providing a service to reward you for either the risk of being in that business or the funds that must be expended in hiring workers and maybe paying their payrolls before money comes in, etc. Now, one of the key aspects of economics, and it will affect transfer pricing, is the fact that competitive forces are always putting pressure on prices. Buyers always want to get a better deal. They're always trying to keep the price as low as possible. Of course, people who are selling are always trying to make as much profit as possible. Capital is always seeking out the profit. So if there are ever situations in which there are economic profits being earned, that is going to draw new competitors into that business. They're going to see that if that particular industry is making economic profits and I leave whatever industry I'm in and go to that industry, I could probably be better off. And similarly, persistent losses are going to lead to people to exit the market. If people are losing money, it means that their opportunity costs are quite high. They could probably exit that business and put those resources to use in some other opportunity that's going to provide them with a better return. Now, in a competitive market, all the buyers and sellers are acting in their own very narrow interest. That's going to establish the price. There's going to be the, Adam Smith's view of the invisible hand is driving the market towards a market price, which is a very efficient price. Sellers, among them, have a wide range of abilities to bring goods to market. That's essentially likely to have differences in the range of their costs. This may include the cost of capital, the return to the entrepreneur. It's also going to create some variation in profits and possibly economic profits. There may be an entrepreneur who is slightly more skilled at doing this job and therefore tends to make better returns. That's really a return to their opportunity cost in many ways. And at the market price, we're going to observe ranges of profitability so that even if every firm were being paid the exact same amount for the goods that they're producing, what we're going to see is that there's going to be some variation in profitability. The marginal supplier, the one that is probably right in at the cusp of the market, is likely earning a zero economic profit. There could be a few suppliers who are maybe slightly better at this than others, have figured out certain cost advantages. They might have a slightly more positive profit, earning some economic return. There will also be some low margin suppliers who might be in the market still who are losing money or not realizing as much economic profit, or not realizing accounting profit as high as the others, could have an economic profit that's actually slightly negative, ultimately one would expect that that pressure of not earning back their opportunity cost would cause them to want to leave the business ultimately over time. But what we see essentially is going to be a convergence with some degree of variability around what is a normal range of profitability associated with selling a particular item. Now, I don't want to forget about risk. There's risk operating in the marketplace. So we have investors who are putting money at risk, and they want to see essentially a return that is commensurate with the risk that they are bearing. So not every business has the same degree of risk. Some are lower risk than others. And when you are in a business that has got a higher level of risk, you're going to tend to expect to see a higher rate of return. A low risk business would expect to see a lower return in that business because that's rewarding the entrepreneur for putting their money at risk. Risk inevitably causes variability in profits, which, when we're using a method like the transactional net margin method or the comparable profits method, risk can be problematic because we may see a wide variation in profitability, which will make it very hard to determine whether, well, one, our range of observed profitability levels might be quite wide, which would mean using profitability of that party as the to determine whether you think the transfer price is correct would be less reliable. We talked about one of the fundamental principles that you need to make in doing a transactional net margin method or a comparable profits method is that the tested party is not taking on risk that's going to produce either high or low results relative to the comparables. And we worked through that example as to what the problems of that would be. So, in summary, there are a number of factors that are going to affect the arm's length nature of prices profitability: scarcity, preferences, competition, and risk. In this examples, we're going to be talking mostly about a very competitive environment, so the competition is very much like perfect competition. In some other examples we'll deal with in the future, we'll be looking at what happens when there are barriers to entry or other key features that might restrict competition and therefore can create a much different scenario.